All right. Hello, everybody. Welcome to our September 10th class. So a couple of things. You saw the employment report. So, I think you have to start with the question, was it a good report or bad report, ignoring what markets did. So you always start there. So what was the unemployment rate? Anybody remember? Boy, I don't know if I can remember.
On the unemployment rate,
Right, the rate, not the jobs added, but the rate.
8.4
That sounds right.
percent.
You may disagree with that number, 8.4?
Yeah, it declined 1.8 and it's at 8.4 right now.
It's declined the last couple of months. So you have to decide on that part of the paper. If you go into Google and just type unemployment rate data and Fed, F-E-D, the Federal Reserve for St. Louis, I won't say it's the best Fed, but it's the best Fed for getting data. If you do that, the Federal Reserve site will come up and you can click on that and they'll have a chart. And if you look over on the right, you can change that chart in a lot of different ways. And then you can download it actually into Excel if you want to. You can use the chart they show, or you can download it to Excel. There's a button on the side that says download. So you might think about this. Remember, your goal is to make your boss look like a genius. So you might want to think, what should I show? Should I show like the last 60 years? And what I think is interesting in showing the last 60 years is just how much COVID-19 really sticks out. I don't know if y'all have noticed that. You're living in a really strange time. I've been doing this for 30, 40 years, and stuff happening this year we've never seen before, ever. That jump, that incredible jump in unemployment, going from 3 point something to 11 or 10, whatever, that's just never seen before. And now the jump back down is the same way. So you might do a longer term look just to show it, but then you might do a shorter term look just to look at what's happened so far this year. You have to decide what really tells your boss the story of what's going on in unemployment. So definitely there's been some recovery, but we're still very far away from where we were in December. And we're also well out of the line of normal. This is definitely recessionary type of employment still. So, think about your charts. That's where you get the most points for critical thinking is, don't look at what the prior students did and just copy that. That's not what your boss is hiring you for, and they're not going to pay you $700,000 just to copy everybody else. So think about what the story is, and then what is the best chart you can come up with to actually tell that story. So you've got a great time to do this because, wow, you got some really wild numbers. So I've never had a class where we're doing this paper where you've had numbers this crazy. So 8.4, is that a good number or a bad number? It looks good versus 3 months ago. Looks bad versus, the recession in 2008. 8.4 was, we got a little higher than that, but that's still a pretty bad unemployment number. All right, what about jobs added? What was that?
It was 1.375.
Was it 1.4?
1.4?
Million, I think.
Like the I think the actual number was 1.375, and Bloomberg expected that there was going to be an increase of 1.35. So it was actually more than what Bloomberg expected.
Okay. All right, good deal. Your microphone still kind of comes in and out, so it's a little hard to hear, but yes. So, make sure you have those numbers exactly right. Now, Diego mentioned the expected. So here's what I tell you on the expected. There's more than one expected number depending on the source. So Diego mentioned Bloomberg. There's other sources. There is an official source, the one that I linked in the paper description. That's probably the most official source, but there are more than one. So I like what Diego said, according to Bloomberg, or according to Reuters, or according to Thompson, or whatever. That's the best when you're using expected. Now, when you're talking about the actual employment number, you don't have to say according to the Department of Labor. The employment number, the number of jobs added, that's a given. We know what that is. That's safe. But when you look at expected, it's usually best to say according to. So look at your source for the expected. Your source might not be the web page you're using. So there may be websites that are using, 7 websites are using the same source. Try to see what exactly the source is. It's usually Reuters or Thomson Bankwatch or Bloomberg or something like that. So it's a little frustrating because the sources can be different. And so when you're reading 3 or 4 different articles, you may discover that you're seeing the expected number was slightly different. But pick one and go with it and stick with it. But if you use the link in the paper description, that's the most official source, at least that I use for the expected number. So both of those numbers, 8.4 is an incredible drop to drop that much in 1 month. The number of jobs added is an incredible number too. That's almost a record number, except for the last 3 months. So we're setting, if you look at anything before 2020, it's like we're setting records every year. Even today, the jobless claims, they say, oh, it's only 800,000. Say, wow, it's really coming down. That's still, today's jobless claim would have been a record in any year before 2019. Everybody's excited, wow, it's come down a bunch. But no, I mean, it's still an incredibly high number. So, so kind of get that perspective. So try to get the lay of the land. The participation rate's very, very important. Did it impact the unemployment rate? So people usually talk about the participation numbers. So if that went higher or lower, that's usually indication. Participation is how many people want to be in the job force. When people get frustrated and give up, they just tell the interviewer that, no, I'm not looking for a job. So they come out of the participation. Once the economy starts picking up, they say, hey, I'm actually looking for a job. They go back into the labor participation. And that can actually cause the unemployment rate to rise, even though it's for good reasons. So you need to read some articles about that. The other number people always talk about is the private payrolls. So make sure you look at private payrolls, especially right now because governments are making some adjustments. So did y'all see the private payroll number?
Well, I actually saw that what's it called, that the I guess the government sector, they added about let's see, 5,800 jobs because
So
of
if that's small, it probably didn't have much of an impact, but you still will want to give the private payrolls. So you can say jobs added were whatever, 1.4 million, private payrolls were X. The expected, you can give the expected, total jobs added was this, the expected was this, private payrolls was this, the expected was that. Private payrolls is not always that important if the government did not make major changes. They have been making major changes the last few months. So if they added this month when they've been cutting dramatically, that might be a good sign. These are supposed to be seasonally adjusted numbers. Because of school starting, that can be real important. But they are seasonally adjusted, although the seasonal adjustments are being really messed up by COVID-19. So who knows if those are even accurate. There's an economist here in town, Keith Phillips, really good economist. He teaches in our graduate program. He has a reputation for being one of the best forecasters in the country, and he thinks the seasonal adjustments that they're doing have some flaws. So, but you're still, it's the best numbers you have. It's what the government officially reports. So this time the private payrolls may not be that critical, but you still give the number because it's always something people are looking at. The other number people almost always talk about is the pay increase, the inflation in pay. So what kind of inflation was there? There's 2 ways to look at that. That's the monthly change and then the year-over-year change. And most people tend to talk about both of those. But the real key there is, are we worried about inflation? Now, I told you if the stock market and bond markets both fall, that's usually an indication of inflation fears. Last Friday, both markets fell. But I'm not so sure last Friday was an inflation scare, but you can look at it. The bond market might have been a little bit of that because if you think about it, the numbers are getting much better faster than expected. And what did the Fed say? The Fed say, hey, you know what? Forget about inflation. We're going full throttle. Well, that's not good for bond investors, right? So it's possible the bond market, that was a really big sell-off on bonds, wasn't it, last week? Almost 10 basis points rise in rates. That's a pretty big sell-off. I think it's possible with the Fed, and the Fed didn't say this on Friday, but putting it all together, seeing better employment numbers. If you're a bond investor and the Fed says, you know what, we're full throttle, we don't care about inflation, let inflation get up higher. We actually want inflation right now. That's a terrible thing to tell to a bond investor when their yields are only 0.5, 0.6%. So I don't think the stock market was an inflationary sphere. I'm not really sure. It's kind of tough to figure out exactly what the stock market was thinking last Friday. The only last other number you might talk about is the hours worked, the number of hours worked. That sometimes is talked about. So look at those numbers. Those are the main numbers, and really ask which ones are the most material. If some of them are not material, you don't need to talk about them, but you almost always talk about the unemployment. You always talk about unemployment rate, jobs added, private payrolls, and the participation rate. Those four you always talk about, and you might find a couple others to talk about as well. So there's the economy. The ISM came in pretty strong last week. So you might talk about that one. Remember, if you talk about the ISM or the jobless claims on Wednesday and Thursday, make sure you set it up in your paper very clearly. Your boss will ask you to talk about those things. So have some sentence that says, to give you a little more perspective on the week, the ISM came out on Wednesday and it was blank. Or to give you more perspective, yesterday jobless claims came out and they came out with a big drop after an unexpected rise the week before. So that's more indication, you just say that's more indication that things are improving. Now, then you might talk about what's going on with Congress, right? Congress is having a tough time figuring out what to do with stimulus. So you might talk about that, all right? Now, real key, everybody real careful on this. I want you to write this paper as if the only knowledge you have is as of last Friday. A lot of stuff has happened since last Friday, but I want you to write the paper as if you're writing it last Friday, okay? So don't talk about the jobless claims this week. Don't talk about the big stock market sell-off and then rally yesterday and sell-off again today. Remember, this is a report you would probably give to your boss by 9 a.m. in the morning. We're going to pretend like she's been in meetings all day long and she's got a meeting with the CEO at 4 o'clock. So she just wants it on her desk before 4 o'clock. So you have all the information for the entire day, but nothing beyond Friday, okay? Everybody understand that? We have to put some scope on this report. I'm giving you several weeks to write something you would normally write in a half an hour or less. All right, that means you can do a much more interesting, much more in-depth report, but don't go beyond Friday. So you can talk about what we knew, Congress knew last week. They were still struggling to get a stimulus, and you probably all heard that the $600 was dropping off and those kind of things. So there are people that are worried that these jobless numbers, or these job numbers are inflated because all that stimulus goes off and those furloughed workers are going to suddenly be unemployed. And that's a big one, right? Those furloughed employees, they're furloughed, so they're counted as part of the employment, but they're counted as being still employed. But a lot of them really don't have any good jobs prospects. They really are out of work. And so you probably read some articles about that. So it's a little tough to interpret the numbers right now, but try to put some good perspective, reading articles, seeing what people are saying so that you can really let your boss understand this report. And then you want to have something you can maybe put in your abstract up front or at a conclusion at the end of whether or not this is good or bad news for the economy. What's the flavor of this? So your boss is meeting with the CEO and you just told her, hey, this is really good news. I think the underlying is good news. It's probably the first thing she's going to say to the CEO. Yeah, the job report came out today and I think it's generally good news. She's probably just going to parrot what you said because she doesn't have time to do all the research you're doing. So have that strongly stated somewhere in your paper. All right, so that's the economic side. Then you get into the market. So the S&P fell 0.81%. But what else could you talk about? Well, it was down by what, 2.3% during the day? So it ended up not being a really big day. It was still down 0.81, a decent down day, but it wasn't down as much as it was earlier in the day. Do you think it was down 2.3% because of the jobs report, or was there something else going on? So that's something you'd have to try to figure out. That's where reading articles helps you out. Does anyone have an opinion on that? Was the 2.3% down entirely due to the jobs report? Or was someone else saying something?
So like, would you say that that I guess the invisible force that drives the markets now is the vaccine rather than
The vaccine. Right, we got news on the vaccine this week, so you have to look and see what we had last Friday. It was probably somewhat positive last week and then negative this week. The other issue you have, and that you could certainly bring up, is that the markets have been so strong. You know, we're hitting these record levels. So there's some say that, you know, you've heard the phrase pricing in perfection. People are pricing in perfection, so it's not necessarily bad news. It's just a lack of great news. The news is okay, it's mediocre, but the market was expecting just incredible news. So have y'all heard, I don't know if y'all have heard the term whisper numbers, but whisper numbers are, you know, you have market expectations and you have what they really expected. And when markets are priced really rich like they are right now, they may say they're expecting this many jobs, but they might have deep down been hoping, man, I was hoping for a much better job than that. I just didn't tell them that when they surveyed me. That's a whisper number. So maybe people were really hoping for much better information. But try to get a sense of what was going on that Friday, especially when the market fell. I gave you the chart. It's out there on Blackboard that shows you how the market moved even before open, so you can get that initial reaction to the job. It didn't react much to the initial release, did it? You look at it, it's pretty flat when it first released. And then a few hours later, it was down a bunch. And then the rest of the day, it recovered pretty strongly. So now some of y'all are using the term, it was a normal market. I don't like that term. I used that last week because I was trying to find a way to distinguish between a 0.5% drop and a 3% drop. So you got to find an adjective. You know, the market fell 0.81% is probably good without other adjectives. You don't want to say it crashed or the market nosedived. You know, 0.81% is a pretty decent drop, but it's not huge. So the market fell 0.81% is probably sufficient. The Treasury market, I would use a stronger word for Treasuries. That's a fairly significant drop, right? 9.9 basis points for 6.5 is then 1 standard deviation. So that's a pretty significant drop. So find another adjective besides Treasury bond prices fell. You might say they fell significantly or...
Consider the following hypothesis.
I'm sorry? Brent, who said that? I heard a female voice.
I think they were like talking to Siri or something, like it was a mistake.
Oh, it wasn't a person. Okay.
Yeah.
All right. I don't know Siri very well. I don't like talking to robots. Okay. So the bond market, find the word, don't use significantly because I just used it, but find a word, go out, use your thesaurus. That's something it's not a crash. It wasn't like a 5-6% drop in prices, but it was a 2% drop or so in bond prices. It's a fairly significant, you know, for a bond, that's a fairly significant move for bonds. So bond market actually fell more than the stock market in price. Remember, we don't talk about changes in price in bonds. We just say how much they fell. They fell significantly. They fell. They dropped. They moved up slightly. What we focus in is the change in basis points. So you want to say something along the lines that the Treasury market sold off, had a significant sell-off as Treasury yields rose 9.9 basis points. Something along those lines. All right. And then what you got to do is figure out, why did markets move like that? I'm not going to tell you that. I gave you some hints there what the Treasury, but look at articles. You're an entry level employee. So your boss is interested in your opinion, but she's far more interested in experts' opinions, those that have been in the business. So your paper is much stronger if you quote someone like Bill Gross or someone at the Fed or someone at BlackRock. What is BlackRock saying? Go to BlackRock's website and see what they're saying. They're a big bond manager. Western Asset Management, big bond manager. Since the bond market moved the most, go find those huge bond managers like Western Asset, like BlackRock, and they probably have something on their website that's telling you what they think happened last Friday, because it's a big move. Our Google BlackRock on the jobs report or something, and just see if you can find something. Unfortunately, we don't have Bloomberg, so you can't go on the Bloomberg machine and look up interviews that happened on that last Friday. If you want to go by the John Peace Library and use their Bloomberg machine, you could go back, you type AV for audio visual, and you find the date of last Friday and go down into the morning, and you'll see some interviews related to the jobs report. And with the bond market moving as much as it did, they probably find someone. I don't know if Bill Gross is interviewed anymore because he retired, but he was the big guru before. But you know, PIMCO, PIMCO, they're a big bond manager, and they were interviewed a lot. So you know, try to find some expert that confirms your belief, and then you can quote them in your paper. It makes it a much stronger paper. You know, your boss is talking to CEO and said, yeah, we think this means this, and your CEO says, why do you think that? Well, I have this student I just hired right out of college, and that was their opinion. That's not going to be as strong. I'm not saying you guys aren't really, really brilliant, but you're also, when you start off, you're always better off having an expert backing you up. I even do that today. I've been doing this for 30 years. It makes me feel more comfortable. I can find someone who has some notoriety that can back up my opinion. All right. And then you find some other things to talk about. So gold has been in the news. What did gold do? So if you're going to say bonds sold off because of inflation, what should gold have done on Friday? If people are worried about inflation, what does gold do? Anybody know that?
A rally.
Yeah, gold should do great. So what happens if you're thinking bonds sold off because of inflation, but then gold didn't move much or went down on Friday? That wouldn't support your argument very well. What did the dollar do? What does the dollar do when you're worried about inflation? It goes down too, right? Gold goes up, the dollar goes down. So that's one you might talk about. The VIX, the volatility index, that tells you how worried people are. I put the volatility index out there. What did it do on Friday? It's possible you can have the market, usually when the market moves a lot, especially down, the volatility index goes up. But it's possible it could go down on a Friday because the volatility index is an index of uncertainty. And because we got the jobs report on Friday, there's less uncertainty. We now know that information. So that's the volatility index. I gave you small company stocks. Because large tech stocks have been moving this market, you might see a very different move when you look at small company stocks. You might look at tech stocks. I don't think I gave you NASDAQ. I don't know if I did or not. I can't remember. I might have given you NASDAQ. The NASDAQ is the tech stocks, and it's the one that's been rallying the most, but it's also been the one that's selling off the most the last few days. I gave you oil prices. I can't remember what else I gave you. I gave you a few, and there's other things you can go look at. I gave you the US dollar. You can also, one thing I gave you was the S&P 500 as a picture. I don't know if y'all saw that, but it's a really cool picture with, it has boxes for every stock in the S&P 500, and the size of the box somewhat approximates the size of the company, not exactly because Apple's too big. And then the color of the box tells you how much that stock fell. So you might look at that chart. I don't know if y'all looked at that, what I put out there on Blackboard, but it's the second chart. Maybe I'll put that up there for you real quick so y'all can see it. It's pretty cool. It gives you not just what stocks are up or down, but gives you a sense of how much they're up or down. So you might actually go to that to see if there's one stock that really, really moved this last week. All right, let me bring it up here. Sorry, I should have loaded it. All right, so let me share this screen with you. So I don't know if y'all have seen this, but the very, very last chart, this on FinViz. It's FINVIZ, V as in Victor, IZ.com. And isn't it a cool chart? This is from last Friday. So Google fell 3%. Amazon fell 2%. Apple was actually slightly up last week. And you can see the color coding down here. So the bright reds are the ones that move the most. Facebook. Now, I can't tell what some of these are, but if you go to FinViz, if you hover over it, it will actually tell you what that stock is. So even Walmart was down 1.18%. That's pretty amazing. So, so there, I'm not saying you talk about all these stocks, but you might find one stock that was down a bunch. Now, I doubt Google was down on Friday because of the employment report. But if there's a stock that, you know, kind of you think represents what's most sensitive to the economy, then you could talk about what a particular stock did. You don't have to do that, but there's something you could do. And then you can see all the other charts that I gave you. If you look at the S&P 500, remember this report comes out at 8:30 in the morning. So you can see 8:30, and the market really just moved sideways for a while. And then for some reason at 10 a.m., this is 10 a.m. New York time, it just nosedived. And then the rest of the day it came up, it got as high as only down about 0.4%. And then it dropped, so it was down 0.81%. Now you got to be careful with what FinViz shows. You see that negative 1.24%. Don't use that number. Use the numbers we talked about. They do things from open, and you don't want to do things from open. You want to do it from previous close. So everything you compare to is to previous close. I hope everybody understands that. This is going to be also really important for paper 2. Previous close is the last market number we know before the unemployment report came out. So previous close is your base, and then you want to compare that to how did the market open, what was its low, what was its high, and how did it close on Friday, all right? I talked about that some in my email, but those are the kind of numbers you want to talk about. Because your boss goes to talk to the CEO, and the CEO, maybe they didn't notice the market came back. And maybe the CEO says, hey, you know, wow, the market was down over 2%. And your boss says, yeah, it was down 2%, but it's recovered. It was down at 2% at 11 o'clock this morning, but it's steadily recovered since then. Got as high as this and ended the day just down 0.81%. So it was a down day, but it could have been a lot worse. You know, it looked like the market recovered throughout the day. So, you know, that's the kind of thing you can talk about. You can put this chart in your paper, but you might try to snip it in a way you don't show these numbers over here, the 1.24%, because that's not what the market did on Friday. Yeah, you have to be careful. FinViz, they do things before and after open. So I think this 1.2% could actually even be what the market did after close, because they keep going. And so don't trust their numbers. You want to use the official numbers we talked about. It's the close on Thursday versus the official close on Friday. You want to use those numbers. All right. So that's your paper, and then a final conclusion at the end. Bring it all together for your boss. You might have an abstract where you do a real high summary of what's going on, or you might have an abstract that says, in this paper, I'm going to talk about the employment report and the impact it had on the markets. If you want to put something in your abstract that generally it was generally good news on the employment report, however, markets reacted negatively. If you want to put that in your abstract, that's fine. Or you have a conclusion at the end where you say, you know, I saw this as generally good news on the employment side, however, markets reacted negatively, and I believe that's because, and you give your 1 or 2 reasons why you think the markets did what they did. If you do that, you will have a very strong paper. Remember, extremely important, don't take the student examples and copy and paste them and make them your first draft. Don't do that. Start from scratch, type your own papers, make it your own thing. The plagiarism will catch those paragraphs if you use too much copying and pasting from other papers. So put it in your own language. If you're not a good writer, send me your paper. I'm very picky on writing style. I had the best boss ever, and boy, he had a degree in English as well as a PhD in finance and economics. Boy, he beat my papers up brutally, and it was so good for me that he did. You've got to become an exceptional writer because we write a lot in finance. So if you're not a good writer, let me pick, you know, send it to me with thick skin because I'll be really picky. Don't send it to me if you don't want me to be picky, but I will pick it apart. And then if you're not a good writer, take some technical writing classes and learn how to write better. If English is a second language for you, I'll definitely help you with that as well. I'm learning Spanish. I know what it's like to try to communicate in other, you know, so I'll help you on those kind of things. You know, get strong. I'm pretty amazed at people learning English and are writing college level papers. I'm really impressed, but it's still a struggle. So I'll help you with that so that when you put this on LinkedIn, you can get it as high quality as possible. Or find someone that, you know, a fellow student to read through it and circle places that seem awkward. Get to the point, you know, be as succinct as possible. Don't say the same thing 17 times in your papers. So, you know, get it organized. So have a good outline so you know where you're going to talk about what. Don't keep mentioning the employment number 7 times in your paper. Just, you know, find some way to get right to the point. All right, any questions on that? It's an exciting paper. I'm kind of jealous I'm not taking this class because it's actually a paper I like to write. I used to have to do, in my job, I had to do this every Friday. I had to write an article for USA.com, and I really enjoyed it. It was me and Cliff that did it, and I wrote the first draft, and he butchered it and rewrote it, and we would fight with each other, and we finally agree what we wanted to do. We put it out there every week, so I enjoyed that. I haven't done that in years, so I'm jealous. Not that I'll write your paper for you, but I am jealous that you get to do this. All right, one last thing we'll do here, unless there's any more questions. So far you've covered DC. So far you've covered DCCU. Can y'all see this in Word? Right? D. Can anybody name those four without looking them up? Off the top of your head?
Duration, credit.
There's a duration, convexity, credit in US versus non-US.
Right. Very good. All right. So I'm going to leave off US versus non-US for right now. So let me give you a scenario. Strong economic recovery with volatile interest rates. What does that mean? It means risky assets are good. What are interest rates going to do? Are they going to rise or fall? Strong economy.
Rise.
Oh,
Probably rise. All right. And interest rates are volatile. So what do you want to do? You want to shorten duration, right? Shorten duration. You don't say make duration less or smaller. We use the word shorten. You want to move to higher risk assets like what? Like high yield bonds, right? So that's where the credit comes in. You want lower credit firm bonds. Why? You get a higher yield and their prices will rally as spreads collapse. So just saying that we have a strong economy with volatile interest rates, you would want to underweight long treasuries, overweight lower quality bonds, but shorten duration and avoid mortgage-backed security. So I'm trying to get you ready for the hardest part of the first exam, which is that second question, the tactical side. So if you understand the tactical side, so interest rates are volatile. Hopefully you watched the video on convexity. When rates are going to be more volatile, you do not want negative convex assets like mortgage-backed securities. So you want to avoid all of that. You don't, if rates are rising, you don't want treasuries. So you probably want kind of short-term to intermediate term, maybe BBB rated bonds or high yield bonds. You don't want long treasuries. They're going to fall when interest rates rise. You don't want mortgage-backed securities. They're going to struggle if interest rates are volatile. All right. So let me give you one. You can email me if you want some participation points. So we expect a recession in the next 6 months, and rates will stay low and go a little lower, but be very stable. All right, what would that mean for long treasuries? What will they mean for tips? And do your best. I'll give your participation credit for just trying. All right, sorry, I got some people in the waiting room. For tips, what would that mean for high yield bonds? Now, one thing I'll warn you on high yield bonds, I talked about this in the video. We don't really think about duration with high yield bonds. We don't talk about long-term high yield bonds and short-term high yield bonds. If you expect a recession, what do you want to do with high yield bonds? So don't even worry about the duration, all right? And let's try some triple B rated intermediate corporate bonds. Let's put that, the last one there, all right? So your boss expects a recession. I didn't tell you what interest rates are, well, I did tell you what interest rates are going to do, so I gave that away, but they kind of go together. We expected a recession. Rates are going to stay low and may go a little lower, but they're going to be very, very stable. Oh, I left one out. Sorry. Mortgage-backed securities. All right, so you got 4 things to choose from. Long treasuries, TIPS, that's inflation-linked treasuries, mortgage-backed securities, triple B bonds that are intermediate term, and high-yield bonds. So get all those down in your notes. And just email me sometime by midnight tomorrow. What would you say the overweight, and which of these do you like in this environment, and which one would you not want to do in these environments? All right. We'll talk about it next Thursday in the Zoom, but we're going to get more practice. You're going to see this many, many times. So if right now you're like, I don't have a clue what he's talking about, that should actually excite you, because in 3 weeks you're going to be a pro at this. All right, so this is our first time for me to throw this out at you. See if you can handle this, and then we'll get better and better each time. Remember, one way you learn is to get yourself out of your comfort zone, so I'm just going to throw you in the deep end, and we'll just try this. Watching the class videos and what we said, you know, do your best. Remember, for every asset class, you want to define the asset class, give it subcategories, and give it tactical. So with bonds, the sub-asset classes were DC cuts I, and then with under D, you had duration, you had short-term, intermediate term, and long-term. Then you had the strategy, you expect rates to fall, you lengthen duration, you expect rates to rise, you shorten duration. You want to get used to this template. I want it to become part of your permanent knowledge base and not just short-term for the exam. All right, so we're going to do it over and over and over again, and you'll get to be a pro at this. All right, I want to answer what the answer is, but any questions on what I'm asking here? Everybody understand this?
Like, I guess basically we need to choose which ones we would go for, or
we're using the term overweight versus underweight. Overweight means you like it. Underweight means you want to avoid it some. All right. So if you normally have 10% of your portfolio in long-term treasuries, would you rather go to 15%, which is overweight, or 5%, which is underweight? Okay. So you can use those terms if you like. I don't need to know how much you want underweight or overweight, but if you want to say, I want the overweight tips or I want the underweight tips, that's all I need. Now on the exam, you'll need more than that. You're going to see on the exam, you're going to say, I want to overweight long treasuries because, and you got to give a couple of reasons. We're not going to do that yet. I just want you to try, just give me the overweight or the underweight. All right. And then next Thursday, you can grade it when I give you the answer. All right. So just email it. It doesn't have to be right. So, you know, just email me, show that you're in class, you're paying attention, and do your best. This will give me some indication how well you're following the videos, though.
I had a question. Do we write it in paragraph format, and then do we write it as like I think, like that?
No, for this, it can be really sloppy. You can just write long treasuries overweight, tips overweight, underweight, whatever. Mortgage-backed securities overweight, underweight.
Okay, and is that from our research, or do we semi-do it as our own opinion as well?
Well, no, it's not your own opinion. So
Okay,
it's
so
your
it's from
boss's,
the
it's your
numbers we
boss's
gather.
opinion. Your boss has told you something.
Okay,
So if your opinion differs from what I'm expecting, I'll tell you why I think, you know, if you give a different opinion of what I'm expecting, they're going to look at you funny in an interview.
okay, good to know.
You might be right, but I need to hear your theory on why you think
Why
it's the
it's-
opposite of what I'm saying, all right? So I'm not saying I've got it all figured. I'm telling you what conventional thought is.
Okay,
And
thank
if you have
you.
another opinion, we can talk about it, especially between long treasuries and mortgage-backed securities. There's a little bit of ambiguity there. We can talk about it, but I'll give you the conventional approach that if you said it in an interview, they would say, okay, this person knows what they're talking about. And then if you want to debate another approach, we can talk about that. and see if either you've got a really good insight that'd be really good to bring up an interview, or if you're misunderstanding the how these asset classes work. So we want to get you more and more comfortable. I still want you skeptical and questioning everything, but I also want to make sure you're comfortable with what is conventional approach, so you know what people are thinking when you interview.
Okay, perfect. Thank you.
Sure. All right, anything else? All right, keep watching the videos. If you're not watching the videos and taking notes, if you feel completely lost, then this is again an indication that you need to find another approach to watching the class videos. All right, well, I'll stop it there. I'll stay on if anyone wants to talk about anything, but you can officially get off anytime you like.
So I have a question about the videos.
Uh-huh.
So I wanted to know, because like I'm not very clear. So like could somebody be able to refinance a bond?
Well, refinancing doesn't apply except for callable bonds and mortgage-backed securities. So corporations generally cannot refinance their debt. So if IBM borrowed at 8% for 20 years, and now they could borrow at 3%, they would love to pay that off at par, but they can't do that. We can do it on a mortgage, but IBM can't do it unless it's a callable bond. If it's a callable bond, they can call it based on the rules in the bond, usually with some kind of premium, so they may have to pay it off at 102. I know President Trump, boy, it's probably a year and a half ago, he talked about refinancing the U.S. Treasury debt. People were freaking out. That's not legal. He can't do that. If you bought a Treasury that's yielding 5% and it's now worth 120% of what you bought it for, President Trump can't come out and buy that for you at 100. That's not legal. He can buy the bond from you at 120, but he can't buy it from you from 100. But that's what he's talking about, refinancing Treasury debt. The Treasury cannot refinance its debt. It can buy its debt back, but at market value. So if interest rates are falling, it has to pay a premium. Okay, but mortgages, and that's why mortgages are so important. If you have a 30-year mortgage, you can pay off that debt at par and refinance at a lower interest rate. But what I talked about in the video is your right to do that means you have to actually pay an extra interest rate. So your mortgage rate might normally be 4%, but because you get to refinance it, they're going to charge you an extra 0.25%. So you're paying a 0.25% higher for your right to be able to refinance. Corporations, treasuries, they cannot do that. All right. So don't use the word refinancing for anything except for consumer type of debt. You can refinance your auto loan, your mortgage loan, but you can't refinance the corporate bond if you borrowed money. It's a corporation.
Like, so like, let's say if I were to buy a house right now and the interest rate is 4%, and let's say in one more year I can like finance my home to like 3%, I would I guess like I would have to pay 3.5% at the end.
Well, you have to do the math. So you get to refinance at par. So if you borrow $300,000, you get to refinance $300,000 at par. So your interest rate goes from 4% to say 3.25. But you do have to pay. You may have to pay some points. You may have to pay for an appraisal. You may have to, the thing that's absolutely evil. I've been arguing to change the law on this. You might have to pay title insurance. Maybe stepping on toes, but title insurance. I talked to Sally about this. It's one of my pet peeves. Every time you refinance your house, you have to pay title insurance. This makes no sense to me whatsoever. So you have to add all that up. That can come to $1,500 or more. So you got to look at the difference in the savings and interest versus that. Now you don't have to pay that $1,500. They're just going to roll it into your loan. So what most people focus in is, how does my monthly payment change? So maybe you're paying $1,200 on your mortgage and now it's $1,100, and that includes everything you have to pay to refinance. But yeah, you can do that, but it's not free. You have to pay for certain things. I'm sorry if anyone works for a title insurance company or your parents, but Yeah, I just don't like that business. Other question? Y'all can leave. Everybody's staying around. I'm not going to say something that's going to be like the first question on the next exam because you already know the first question on the next exam. You already know the second question on the first exam. Other questions? Are the videos working okay? Are you understanding them? I know I talk too fast, but have y'all found the YouTube? You can slow it down to like 75% or I think even 40% is pretty ridiculous. All right, no other questions?
Oh, so I have one more
Okay,
question. So on one of the videos, you gave an example, and it says your boss believes interest rates are going to rise significantly over the next 12 months.
okay.
Either due to expected strong economy or rising inflation, or both. You recommend that the firm shorten the duration of its bond portfolio.
Yeah.
So what would that mean? Like, would that basically mean that I guess that we should like sell the bonds, or
So you have a bond portfolio and it has a duration. Duration is a lot like beta. The duration of your bond portfolio is just the weighted average duration of every bond you have in the portfolio. So you have some 10-year bonds, you have some 5-year bonds, you have some 3-year bonds. So to shorten the duration, you would sell your 15-year bonds and buy some 3-year bonds. And that shortens your duration. So the duration of a 15-year bond might be 11 years. And the duration of a 2-year bond might be 2 years. The duration of portfolio is just the weighted average of all your bonds durations. So if you sell the 15 years and buy the 2 years, your duration is going to drop down. It's the same thing we'll talk about with beta, right? The beta of a stock portfolio is the weighted average beta of all your stocks. So if you want to reduce the beta on your portfolio, you sell high beta stocks, you can buy low beta stocks. If you want to reduce duration on your portfolio, sell long-term bonds and buy short-term bonds. Now, there are other ways to do it with bonds. At USAA, I did interest rate swaps. You can do futures. There are other ways to shorten the duration of your portfolio without having to actually buy or sell bonds. I don't see, yes. If you take my risk management class, we actually use interest rate swaps to change duration. So if you take that class, I'll show you how to do that. That was my favorite thing to do at USAA was interest rate swaps. I did a few billion of them and a few $1 billion of them, and it was a lot of fun. It was a blast. I felt like I was doing like really fancy stuff. It really is really cool stuff. So that's the nice thing with bonds is you can change duration real easily because of derivatives, and we'll talk about derivatives at the end of the class. But basically, if your firm can't do derivatives, the only way to change duration is to sell the long-term bonds and buy the short-term bonds. Yeah, I always bring up these other things because boy, finance is really exciting. It's amazing the stuff we can do. So you look forward to the stuff you get to do. I'm jealous y'all get to do this. I'm finished. I'm retired. All right, nothing else?
Oh, I know in the video you talked about how another professor did the tax equivalent yield, but differently. Like, what's that like? Like, I don't know. Could you expand a little?
Well, the logical thing is to take the corporate yield and multiply it by 1 minus the tax rate. And that's the way she did it in her class. That's the way I would do it if I were doing it, but I'm showing y'all how it's actually done in practice. In practice, they take the tax exempt yield and divide by 1 minus the tax rate. They gross up the tax exempt yield. Now, her argument is that yield doesn't exist anywhere. I say, yeah, it doesn't, but the people doing the calculations are the tax exempt bond managers. They're the ones making the rules. So they're going to do it in a way that makes them look better. So they come up with the rules, and that's just, I don't know why I don't know who invented that, who started that. It was probably some municipal bond manager. I agree with her. It doesn't make logical sense, but you get the exact same answer either way you do it. So to me, it doesn't matter. That's the way I did it at USAA. I would take tax exempt yields, I'd gross them up, I'd send them to the bond manager and let her know whether we prefer tax exempt over taxable. And she would make that decision based on that. Jose, did you have a question, or someone else was saying something?
Yeah, I was going to ask, what class do you say that, like, you recommend to take if you want to know about this?
Risk management is where we do it. I know Catapacum does swaps in his class as well. If you're interested in working for a bank, in my risk management class, we do balance sheet immunization with the bank. It's a really cool thing to do. It's a big part of my career. And we walk through an example. If you can't wait until then, there are YouTube videos that walk you through the entire exercise. If you want to go out and look at them, let me know. I'll send you those videos, and you can get a head start on it. It's something I learned when I took the CFA exam. And when I came back to USAA, I was at a USAA bank ALCO committee meeting, and they had never heard of it before. So I was teaching the financial executives at our bank how to do bank balance sheet immunization. I'm thinking, wow, I just learned this myself on the exam. It's really cool stuff. I did it for a pension plan at USAA, and my word, it saved us over $1 billion in 2008. It was huge. It's really powerful stuff. So I love it. It's really powerful because in one phone call, you can manage billions of dollars of interest rate risk real easily. So it's really powerful stuff. Reading about it, just type interest rate swaps and see what comes up. All kinds of articles will come up.
Thank you, sir.
Sure.
Have a good weekend, sir.
Yeah, you too. Yeah, all of y'all. It's getting chilly, so it's not so hot. All right, I'm gonna get off unless someone says something quick. All right, adios. Hasta luego.
Hasta
Bye.
luego.
Good day.
Thanks.
Bye.